join Karniol-Tambour. She is the Co-Chief Investment Officer for Sustainability at Bridgewater Associates. Really good to see you, Karen. Thanks so much for joining us. I want to start off with what we're seeing out of Germany, where business confidence, the IFO index, came out. It's looking really, low in comparison to what we saw over the past 2-3 years. What does this tell you when you see Germany coming under so much pressure with risks still very much on the horizon?
Well, thank you. It's great to be here. I think conditions facing Germany and Europe as a whole are the toughest they've been in decades. And I think the business survey reflects what makes sense, which is that growth has slowed to, right around very close to zero, and a recession is very likely. I mean, there's been a shift to stagflationary conditions, meaning growth is bad and inflation is high at the same time everywhere, maybe outside of China or so. But in Germany, it's been maybe the worst, because there, not having energy very directly means you literally can't power the type of economic growth you need. Energy is literally being pulled back, and they just don't have the energy they need. And they have a lot of industry that's reliant on literally using energy that's not there anymore in order to power its economic growth.
Look, you mentioned stagflation, and I'm looking at all the economic data we're getting out of the US this week. The GDP number is going to be absolutely vital. We're getting inflation. We're looking at consumer confidence. And of course, we mentioned it in our earlier conversation with our correspondent, that it's not a matter of whether they're going to cut. It's just by hike rates, rather, but just how much they're going to hike. And it puts the Federal Reserve in a really precarious and sticky position, because they have to focus on price stability as opposed to growth.
I think it's the toughest set of circumstances the Fed has been in since, the 70s or so, just for the reason you're saying, that they really can't achieve their dual mandate at the same time. They're going to have to choose between getting inflation under control and having growth be a lot weaker than they're hoping, or having growth be strong and not having inflation under control. And that's a very tough spot to be in. Chances are they're not going to be able to sort of keep one decision, and you'll see them kind of go back and forth, which is why you're going to look back and say this is a period of stagflation. Growth is too low, inflation is too high. It's kind of gone back and forth. And one of the important things to remember on a week like this is that the Fed hasn't literally hiked rates, but that's already expected by the markets. And so if you look at the way market pricing has been, it has priced in the biggest change we've seen in decades, from no tightening expected to a lot of tightening expected. So the impact on the economy starts getting rolling, that ball gets rolling, before the Fed actually raises rates, right? That gets priced in, it gets expected. The further out rates, like mortgage rates, start rising. And so the makings of a recession, the makings of a slow our economy because of that tightening, are already kind of in the system and making their way to hurt household wealth, to hold household confidence, to make it harder to borrow. And so the Federal Reserve is very quickly going to be seeing growth falling a lot more than they'd hoped, and yet not seeing inflation coming down as much as they'd hoped, and being in that tough spot and having to choose what to do next.
Yeah. Exactly. Yeah, it's a painful process, right? Once inflation starts to bite. There was a time, a couple of years ago, when the Fed was saying, look, we have to start pulling back on the stimulus. We have to stop with the easing. Do you believe that we should have seen more of a proactive approach in order to be in a better situation than we are right now? And do you think they have to be more aggressive and hike rates more aggressively, because inflation is dangerous? It's dangerous to have out of control inflation, especially with the global risks on gas and food prices.
I think the Fed absolutely waited too long and believed for too long inflation was transitory. But the thing I will say is that a lot of the reason we got here is not just Fed policies, was the mix of Fed policies and fiscal policies. So what proved so effective without inflation going at such a high rate as we're experiencing now is the fact that not only was the Fed so easy and printed money, but at the same time, the federal government put so much stimulation to respond to COVID. I mean, they literally sent every person a check. And so that combination of money printing and literally getting money into people's hands so it could be spent, you're not relying that you hope they'll go borrow. you're not relying that quantitative easing will somehow trickle down. Literally, people's checkbooks changed, their bank accounts, they had more cash at hand than they've had for a long time. We saw household balance sheets getting better. We saw it happening throughout the whole economy, not just the wealthy, because everyone got a check. And so that mix of policies wasn't just the Fed. It was the Fed and tremendous fiscal stimulation. And yes, the Fed was too slow in responding to what was then a massive boom coming out of COVID and pulling back. And part of the supply shock that's now happening is, a confounding factor that is happening for them at the worst possible time. And so we could have had a war, at any time in theory, but it happened at a time where inflation was already getting going and when energy and food markets were already very tight. And so it only took a small disruption to create a very serious supply shock on top of what was already a booming demand, a set of situation where people had more money to spend than the economy could possibly supply.
Karniol-Tambour, thank you so much. Good to see you.